Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. Today's video is to review future contract obligations, financial obligations in more detail, and how to select a commodity broker. That is key, and we'll get to that here in the end. So today's topics include broker's fees, financial obligations, also known as margin money, margin calls, real life simple examples using futures contracts, and then at the end, how to select that commodity broker. So our first topic today is about commodity broker fees. And there are two components to the financial obligations of traders. So whether you're a speculator or a hedger, when you open that commodity account with a broker, they're going to charge you a brokerage fee, which is also known as a commission, and there's also a margin or a bond requirement. The commission is a fee charged by the broker for filling your order. They're going to execute an order, whether it's a buy or a sell. If the commission is $50, it's going to be $25 to buy, $25 to sell. The entire commission is charged on the first transaction because literally all trades are offset at the end of the day. That charge, that commission charge for both transactions is known as a round turn. There can also be small exchange fees as well. Our second topic today is about financial obligations and margin money again, or margin calls. Again, the initial margin, we've talked about this before, or bond requirement is a small portion of the value of the contract that is required as a bond when a trader takes a position. Whether it be a speculator or a hedger, usually less than 5% of the value of the contract. It's a good faith deposit, and its purpose is to guarantee financial performance. Both traders, the long and the short, deposit a margin when a position is opened, but the trader who is losing on paper is responsible for maintaining 100% of his or her paper losses. Our third topic is, again, using some examples. Let's try to keep it as simple as possible to explain margin. A hedger, farmer, sells November soybean futures. We're using soybean futures as our example. Again, selling, thinks the price is going to drop. US per bushel, $13.80, with initial margin of $3,500 per contract. Remember, the contract is equal to 5,000 bushels. 10 days later, the price increases by US 50 cents per bushel to $14.30 a bushel. Additional margin is required, 50 cents times the 5,000, value of $2,500 per contract, to bring the original margin back to $3,500. For the trader who is long, the original margin was also $3,500, but there is no additional margin as long as the price doesn't drop below the $13.80 per bushel. Let's use wheat as another example. The hedger farmer sells December Chicago wheat futures. He's short US 930. Remember, he's long wheat in the ground. 930 per bushel with initial margin of $2,500 per contract. 10 days later, the price increases by US 10 cents per bushel. Additional margin required is 10 times the 10 cents times the 5,000, which equals $500 per contract, to bring the original margin back to $2,500. For the trader who is long, again, the original margin was $2,500 as well, but there is no additional margin as long as the price doesn't drop below the 930 per bushel level. Our fourth and final topic today is about how to choose a commodity broker. This is key because the commodity broker can make a huge difference to your bottom line. Remember, these guys are paid on commission, so they try to generate a lot of commission to pay their bills and feed their kids at the end of the day. They're good guys, but be careful, okay? So because you don't want to generate a lot of trades within your account. Remember, you're a hedger. So a farmer is long commodity, corn, canola, soybeans, wheat in the ground, and will need to open up a commodity trading account. This account is known as a hedging account, not a speculative account. If you want to go and speculate, keep the two accounts separate. The farmer will need to prove to the brokerage house whether he or she plans on growing and hedging in the course of a year. A farmer will never go long futures, otherwise he or she would be double long. This is known as being a speculator, and you will now have increased your risk by twofold. The exception to the rule is a livestock producer. Why? Because a livestock producer is afraid that maybe his feed costs, if he doesn't have feed, corn in the ground, to feed his hogs or cattle, he's afraid that that feed's going to go higher. To protect himself of a higher feed cost, he could go long futures. That's the exception to the rule. If you're a cash crop producer, you would not want to do that, except for In limited examples where you've maybe booked your corn at $5, you think it's going to $6, you booked it too early, you could buy a call option on top of that physically booked corn at $5. Some will still say that you're a speculator. There are many financial institutions that can help a farmer set up a commodity hedging account. You can trade online for as little as $4 a round turn. Remember the round turn? Commission in and out. But if you're going to do online, you better be sophisticated at it, because if you press the wrong button, it could cost you a lot of money. Again, this is only for sophisticated hedgers and speculators. Following is a list of a few of the institutions that a farmer can call and review and compare fees with. So there's RBC, Royal Bank, Freeburg Mercantile, Scotia, RJ O'Brien, Deutsche Bank, Refco, Union Securities, Goldman Sachs, New Wedge Group, JP Morgan Futures, Deutsche Bank, Citigroup, UBS. Just Google some of these companies. The best thing is usually just to ask another farmer that maybe has a commodity account, or an advisor that you're working with that could recommend somebody to you. The role of the commodity broker should be limited to understanding and assisting in the execution of your marketing hedging plan by filling orders promptly and providing you with accurate and timely position records and statements by either mail. Now I'm assuming they still send, they'll send you emails as well. Many so-called experts get the direction wrong most of the time, so please do not rely on them for advice. Trust me, the hedge, it turns into a speculation, the wheels start to come off, and you'll never trade futures ever again. So again, manage your expectations. Let's not get any surprises here. If you do it properly, this can help you hedge your risk going forward. So in summary, knowing the fees and obligations when operating commodity hedging or trading account will prevent a farmer from experiencing any future surprises. Remember, futures should only be used to hedge, not to speculate. If you're long corn on the ground, you're short futures. Once a farmer has sold his, her long commodity in the cash market, so now you've shipped the corn bushels that you harvested that were in the ground to a local elevator, only then can that farmer buy back that hedge or short futures position, because until then you're still speculating and there's a lot of risk. Once you've shipped the corn, you can call the broker and say, hey, I want to buy back that short futures position. The difference is profit in your pocket, plus or minus your local basis. Thank you for spending some time with us today, and we hope that we have shed some light and insight on understanding the fees, financial obligations, margin, and how to use a commodity broker. Until next time, thanks for watching.